Hi. Before starting the webinar, I wanted to take the opportunity to apologise to any attendees who tried to view us live earlier today. Unfortunately, our guest panellist was unable to enter the call in a way that would have allowed him to be seen on your screens. It became very clear shortly after 1 p.m. that we would not be able to continue with the live session and instead would need to record and publish it later on. While I did communicate this to the attendees at the time, I was very flustered, and in hindsight, I appreciate that this should have been done in a much better way, with a proper explanation. So please accept my sincere apologies for the inconvenience caused, and my thanks for bearing with us. On a more positive note, I'm pleased to confirm that we were able to record the webinar on the same afternoon, and here it is. I'm sure that, like me and Rachel, you'll find it very insightful and helpful. Thank you again.
Good afternoon, welcome to this live webinar, which is today looking at VAT in the construction industry. I'd like to welcome my co-host, Rachael Brown, who's now a fully fledged member of our tax editing team, taking over from the long-serving Tony Court last month.
Thanks, Andy. It's obviously a pleasure to be here with you both. So as you mentioned, today's topic is VAT in the construction industry, and I understand that Neil's going to talk to us about when construction services are zero rated and when they're subject to the 5% VAT, when contractors and subcontractors will charge different rates of VAT on the same job, HMRC's approach to compliance visits, accounting for VAT, reverse charge rules, tax points, invoicing, bad debts, and does business splitting work?
Well, that sounds like quite a lot to cover, so I suppose we should get cracking. Our guest panellist today is none other than Neil Warren. Neil is one of the country's leading VAT experts and will be a familiar name to any of you who read any tax-related publications. Neil writes the VAT content for our own newsletter, Tax for Professionals, as well as being the contributing editor for Tips and Advice VAT, both of which are included on the Tax Essentials for Advisors platform. So, Neil, perhaps we should start with zero rating, as I believe that this is an area that's often muddied by my mate at the pub says kind of situations. Could you give us a brief summary of when construction services should be zero rated?
Yes, good afternoon, everybody. There's three main situations when builders will zero rate their services. And I'll try and give a little bit of a twist to the tail on each of the three examples. So the one that's probably most well known about is zero rating applies to construction services to build a new dwelling. And when we say dwelling, one of the key things on this issue is to be very clear about what is defined as a dwelling. And in VAT Notice 708, there's actually some 4 conditions which are direct quotes from legislation about what is a new dwelling. So to give an example, if you demolish an existing house, an existing building to bare land and build a new dwelling on that land, that will be zero rating. And if you retain a single facade from the existing building you demolished as a condition of planning consent, or a double facade on a corner, then it can still be a new build and zero rated. One of the important conditions of a dwelling is that it must be capable of being sold in its own right. I love to tell the story of a situation I had many years ago, probably 20 years ago now. A farmhouse. They constructed a new bungalow next to the farmhouse for the farmer's mother-in-law to live in. It looked like a new bungalow. It had all the features of a self-contained dwelling, i.e. bathrooms, kitchens, etc. But in terms of the planning regulations, it could only be sold jointly with the farmhouse. So it wasn't an extra dwelling that could be sold in its own right. It was part of the farmhouse, therefore it failed the condition of a dwelling, and the building work was therefore standard rated. So new dwellings is situation 1. Situation 2, work on a new building which we use for a relevant residential purpose. For example, home for elderly people, student accommodation, or nurses accommodation. And little twist here, little important condition is that the new building must be the main residence of at least 90% of the people who live there. And there's been a few cases over the years where that 90% test hasn't been met. For example, people are there temporarily in a particular building, and therefore it doesn't qualify for a relevant residential purpose. So 90% of the people living in that building must be there permanently. Finally, the third building is a new building that's used for a relevant charitable purpose. Now, this basically means by a charity for a charitable activity or a non-business activity. So let's think of an example, bare piece of land, and the charity builds a new charity shop to sell donated goods. Now, that is a business activity of the charity, so that particular new build would not qualify for zero rating. So when we say a relevant charitable purpose, we're thinking about, for example, accommodation or building for, say, homeless people for a charity in that sector, or looking after animals, or in fact, a church, a place of worship. So one of the little twists, again, with an RCP, relevant charitable purpose building, is you can have a small amount of business use, up to 5%, and the building work will still qualify for zero rating. So that's giving scope for a new charity building to perhaps have a small coffee shop, taking a small area to raise some funds. And as long as the 95% test is met, then zero rating can apply. In all three cases, the zero rating provided by builders extends to materials they supply as part of their work. So it's labour and materials that are zero rated.
So are there any situations when builders will charge different rates of VAT, even though they're just working on one project?
Yes, there are. And it won't happen with dwellings. So if you have a new housing project going on with bare land, building 50 detached houses, then subcontractors and the main contractor will all zero rate their services and the materials they supply. Where we've got a difference, and this brings me on to an important issue about VAT certificates and when they need to be issued. If we're looking at an RCP building, the charity building, or an RRP building, the residential buildings like the student accommodation, then the zero rating is only secured when the building owner certifies to the main contractor that they will use this new building for the relevant residential purpose or the relevant charitable purpose. So it's the certificate that's retained and by the main contractor that secures the zero rating. The subcontractors working for the main contractor, they don't have those certificates. So therefore, their services, their supplies are standard rated, which should not make much of a difference, because in the modern world, it falls to the reverse charge. But in any case, the zero rating by the main contractor means they claim input tax anyway on all the costs they incur on a particular project. So certificates only go to the main contractors and not the subcontractors for those two types of building.
So in practice, what would you advise a subcontractor who gets a copy of the VAT certificate from the main contractor, instructing them to zero rate their invoice?
Yeah, I've had this question over the years quite often, where the main contractor issues the certificate from the charity or the residential building owners and says, look, this particular job is zero rated, don't charge us VAT zero rate, which of course is completely incorrect, completely wrong. What I do in that situation is I suggest to the subcontractor or subcontractor's accountant they refer the contractor to VAT notice 708, which is HMRC's Bible on the construction industry. And amazing, that particular notice has been going since 1983 when I first started working in VAT. So it stood the test of time. Refer the main contractor to that notice 708, which clearly states that only the main contractor can zero rate. And hopefully they'll look into that and they'll come away and agree that the zero rating is not applicable. And it's important because if subcontractors don't charge VAT or VAT is lost in the equation, then the subcontractors are going to have the problem with HMRC. And that's always an important point about VAT, whether we're talking about construction industry or medical industry or any industry. It's always the supplier and not the customer who dictates the correct rate of VAT charge on any supply of goods or services. So hold your ground, that notice 708.
I've often wondered what would happen then if a charity or a club, say, issues a certificate saying, the new building that we're putting up will qualify as zero rated, and then the building falls short of the conditions. So what would the consequences for the builder be?
Yeah, so there's been a number of VAT cases on this issue where charities or not-for-profit organisations have issued VAT certificates saying, we are a charity, we're building a new building for a charitable purpose or use as a village hall. Village halls are also zero rated if they're new, community buildings. And then the builder accepts the certificate and says, oh, that's great, I won't charge you VAT on zero rate. And then HMRC come knocking at the door and say, oh, no, this has fallen short. The good news for the builders is that as long as they've acted in good faith and accepted the certificate and applied routine due diligence checks to make sure that what's being said on the certificate is accurate, then HMRC will go for the building owner and not the builder. And the way they do that is they can't charge VAT to the charity. What they do, they issue a penalty, which is known as a Section 62 penalty. That's a reference to VAT Act 1994, where they say this is a £100,000 job. It shouldn't be zero rated. Here is a 20% penalty to the charity or building owner for £20,000, which produces the same end result, i.e. HMRC get their 20%. I always enjoy talking about this particular topic because over the years there's been quite a few tribunal cases where community amateur sports clubs, CASC, think they're charities, and they think that because they don't make a profit, they're run by volunteers, members committee, they tick the boxes for a charity. They don't. And there's been a few cases over the years. Eynsham Cricket Club is one, Whitney Bowls Club, where unfortunately HMRC won the day because the building, the cricket club, the bowls club, they're not charities. They are CASCs, which is a different issue.
So if we move on to the 5% VAT rate, Neil, I know that when zero rating isn't in point, the reduced 5% rate applies to some projects, but could you summarise when it applies and maybe give us some practical examples, please?
Yeah, sure. The 5% rate came in, Gordon Brown was Chancellor, and it was part of a regeneration project to try and make use of buildings that have been either empty for many years or commercial and disused to try and get them back into dwellings. So Gordon Brown was Chancellor, 97 to 2007. So these 5% rules have been in place a long time. There's always been talk about abolishing them and making them into 20%, but they've stood the test of time. So the three main situations when we get 5%, we're all talking about dwellings, so not commercial properties. And the first one is when you convert a commercial building into dwellings. And two examples of that is you've got an office block, which is now no longer used as an office, it's because of home working, and they're converted into apartments, into flats. So start off commercial, become residential. All of the building work, including the material provided by the builders, qualifies for the reduced 5% VAT rate. That is an important one. Pubs closed down. I think there's about 5 or 6 pubs a week are closing down. In most cases, they're being converted into dwellings. So again, 5% applies. Situation two is when you've got a residential building or a dwelling that's been empty for at least 2 years. Now, the key issue here is when we say empty, we mean not lived in. So if somebody says, oh, my holiday home in Cornwall, I've not been down there for 2 years because the weather's been so bad. Well, we can't say that after this last summer where we had a heat wave for many months. That's not an empty building. It's basically one that's not been lived in for at least 2 years. And the builder, who will charge 5% VAT on any improvement or renovation work on that particular property, must be given proof of the empty period by the property owner. And that proof has got to be independent evidence. It can't be, for example, a letter signed by the property owner's accountant or the property owner's solicitor. It's got to be, for example, council tax data, a letter from the housing officer, electoral register saying that nobody's lived in that property for X number of years. HMRC kindly accept that squatters illegally living in a dwelling, that can be excluded, but basically it's the empty period needs to be properly substantiated to support 5%. Thirdly is when you start off and finish with a different number of dwellings, and that change in number can be up or down. So if you've got a detached property which you convert into two semi-detached properties, two semi-detached dwellings, or you convert it into an upper and ground floor flat, the change in number from 1 to 2, all the work then becomes 5%, and downwards as well. So if you start up with two semi-detached houses, convert them into one big detached house, the change in number is what counts, 5% VAT on that one as well. So again, the 5% rate applies to materials. One thing I should say is that any professional services or any project, for example, architects, surveyors, project managers, solicitors, estate agents, is always standard rated. The exception is when you have a design and a build contract, when the design services follow the same liability of the building work, and that is a useful planning point that's been widely adopted over the years by charities who can't claim input tax. If they have a design and build contract, then zero rating can extend to their professional services as well.
And so what happens if a building's got a mix of residential and commercial use? So as an example, what would happen if a pub with owner's accommodation was then converted into a ground floor and a first floor flat? Would that cover all the job or part of it, or not at all?
Yeah, what you've got there with the change in numbers, one of the quirks of the legislation, which I share with you now, is that if, for example, you've got a block of flats with 10 floors, when it comes to the change in number, you're looking at each floor in isolation. So if the fifth floor of a block goes from 5 to 4 flats by making the existing flats bigger, and then the floor below goes from 4 to 5, then the total number over the 2 floors is unchanged. Start with 9, finish with 9, but in isolation, each floor has had a change in number, so therefore 5% applies. So with your example of the pub, the ground floor of the pub is commercial and will become a ground floor flat. So that is a change from commercial to residential, so 5% VAT on that particular project. The first floor accommodation in a pub, the owner's accommodation, is already designed as a dwelling, so therefore the work to effectively create the first floor flat will be 20% VAT, because it starts as residential and finishes as residential. The only exception would be if the accommodation upstairs has been empty for more than 2 years, and then we've got the 5% on a different clause in the legislation. But you need to look at each part of the building in isolation.
Okay. So to take things a stage further, then, what would happen if a builder incorrectly charges full standard rate VAT when it should be 5%? Could the customer then recover the input tax that they've been charged incorrectly?
No, one of the rules about input tax is you can only claim VAT that has been correctly charged in the first place at the correct rate. So you might have a situation, let's give an example. If I go into a bookshop and I buy a book on VAT, that should be zero rated because it falls within the schedule which qualify for zero rating. So if the bookshop charges me £100 plus VAT and I pay £120, they give me a tax invoice saying sale a book on VAT, 100 plus VAT. I'm VAT registered. I cannot claim input tax because it should be £100 no VAT. £20 is incorrect. The fact I've got a tax invoice, I've paid the VAT, I've got the VAT number of the bookshop, and it's a business expense or purpose of a business is irrelevant. I cannot put it on my VAT return. If I did, it becomes an error which needs to be corrected. The recourse is for me to go back to the bookshop and say, look, this is a zero rated sale. Can you give me a VAT credit for £20? And that will sort the problem out. So in the case of the 5% versus the 20% rates, then it's not quite the same situation, because if, for example, there's an invoice for £100 plus £20 VAT, and I pay £120 to my builder, and it should be 5%, not 20%, then I've basically paid £120, including 5% VAT. So I apply the VAT fraction to the £120 that applies to 5%, which is 1 divided by 21. I can claim that as input tax, but then I go back to my builder and say, I need a VAT credit for 15% of the VAT because you should have charged me 5 instead of 20.
So now if we move on to a chat about HMRC, Neil, if you've got any insight on what the current approach is as far as their compliance checks on builders are concerned, we'd love to hear it.
Yeah, when I was in the department between 83 and 97, it was very different times. We did visits to premises of the traders, and in some cases we went to building sites if we went to builders and looked at what they were doing, and it was all in the local area. So, my career as a VAT inspector was in Northampton and Luton and Milton Keynes, and we dealt with those local businesses. And things are now very different, and we know that basically it's HMRC verify input tax and output tax, usually remotely with emailing and whatever it might be. So, and we also know that HMRC have got very great restraints when it comes to staffing levels. So probably with most traders now, at the moment, construction industry is not seen, I don't think, as high risk within HMRC, not, for example, compared to other industries like the medical services industry at the moment is something they're looking at very closely, where cosmetic treatment is being exempted by many medical practitioners, where they think it should be standard rated. So at the moment, I don't think construction industry is high risk on their agenda, and that it's probably been helped when the reverse charge rules came in 2021, because it took away a lot of charging VAT, disappearing with the output tax, and HMRC left carrying the can with quite a big VAT fraud situation. But where I do think that care is needed is in two situations. One, where builders submit repayment VAT returns, i.e. they're doing some zero-rated work or 5% work, minimal output tax, they've got a lot of input tax to claim on building materials and professional fees, etc. So all repayment returns need to be given a little bit of a closer attention before the send button is pressed. And the other one is any newly registered business, HMRC continue to always or mostly check any first period repayment returns submitted by a business to verify A, that the business is genuine, B, that records are being kept, and C, that the early input tax claim submitted is actually genuine. There's actually a VAT case only a couple of weeks ago. Very strange. A builder constructed 2 houses in 2021, and they were sold in 2021. And to cut long story short, he became VAT registered in 2023. I mean, his first VAT return claimed all the input tax on the cost linked to the 2 houses, which were 2 years earlier. You think, well, that's a good deal. So to not have to worry about any output tax and go back and claim the input tax on a project that was put to bed 2 years ago. Needless to say, he lost the case on that, and he hadn't even kept proper records anyway. So that was a mystery, but these cases do crop up. So they're the two messages: repayment VAT returns and the first return that's a repayment as well. Make sure they're always given a double checking.
Excellent. Yeah. Aside from, say, Brexit and making tax digital, which we've had over the last few years, there was another big VAT milestone back in 2021, wasn't there, when the reverse charge domestic reverse charge came in for supplies of construction services. To start with, can you summarise how those rules work and highlight any particular problem areas in practice?
Yeah, that's right. When these rules came in on the 1st of March 2021, and they'd been delayed twice before. One was due to COVID and one was due to businesses needing more time to understand the rules. I always felt that the construction industry would adapt very quickly to these new regulations and find them, in 99% of cases, very straightforward. And of course, we need to support any objective that is intended to reduce VAT fraud, where VAT is charged at 20% by a supplier who pockets the VAT from the customer and then disappears, and HMRC never get the VAT. So I was always in favour of the new regulations and felt that the second deferral was perhaps not really needed. But they've now been in place for 4.5 years. I think they've worked very well. So to summarise how they work, there's two very useful flow charts. If you Google on HMRC guidance, reverse charge construction industry, then you get the main manual about how this all works. And then in the Appendix 6, there's two very easy flow charts with only about 4 questions each. One is for the supplier of construction services and one is for the buyer of construction services. And they're yes or no answers. And at the bottom it says, yes, domestic reverse charge applies, or no, it doesn't. So let's take a supplier. So I'm a builder and I'm doing some work for a main contractor. So I'm a subcontractor. The first question I ask is the work I'm doing covered by the construction industry scheme, the CIS, for example, obviously plumbing, bathroom installation, brickwork, carpentry, roofing. Not all construction work is covered by the CIS. For example, repair of plants and equipment is excluded. So does the work fall in the list? Answer yes. Let's take fitting a bathroom suite. Secondly, is my customer both CIS and VAT registered? That should be easy to verify with either checking the VAT number on the HMRC website of the customer or seeing a copy of their VAT certificate, and the same with their CIS registration. That's question 2. And then the next question is the work subject to either VAT at 5% or 20%, because zero-rated work is excluded, quite understandably, because there's no VAT being charged. There's no potential tax fraud on a zero-rated job. So that's number 3. And fourthly, and this is the most, when I say not the most important one, but the one that caused more confusion and perhaps controversy, is has the customer confirmed to me that they are an end user as far as the work is concerned? Now, what exactly is an end user? Basically, it means that the main contractor we're talking about, with his VAT number, his CIS number, applying the building services of our subcontractor, is not selling on the services in question. So your typical situation, you've got a main contractor working for an end user, let's say a hotel. Contractor invoices the hotel, contractor uses subcontractors, the subcontractors invoice the main contractor. So you've got a chain of building supplies, subcontractor to main contractor to the final customer. So if the main contractor, the buying the construction services, says to the subcontractor, we are an end user as far as this work is concerned, that means that the reverse charge does not apply and the subcontractor adds 5 or 20% VAT to their invoice in the usual way. Now, the key thing with end user is it's the buyer that confirms to the subcontractor, yes, we are an end user, don't charge us VAT. If the main contractor is silent and doesn't answer that question, or it's not shared with the subcontractor, then the reverse charge continues to apply. And let's be honest, it's better for any buyer of a service not to be charged VAT than to be charged VAT and then claim the input tax back 3 months later, on a VAT return. So the end user issue, all the subcontractor selling the services needs to answer as the question is, has my customer, the contractor, told me they're an end user? Answer no, reverse charge applies. Once the reverse charge applies to any supply of construction services, otherwise it ticks the 4 boxes, then the subcontractor, the seller of the building services, does not charge VAT on their sales invoices. They include a note on the invoice saying reverse charge applies. This work is subject to 20% VAT or 5% VAT. There's a clear message to the main contractor to account for the reverse charge on their own VAT return, i.e. accounting for output tax in box 1, claiming input tax back in box 4, nil effect overall on the payment, and include the income or the payment in the case of the buyer in box 7 as an input, and the seller includes the output in box 6 to record the income. So it's an anti-fraud measure, and in my view, it's worked very well. I'd like to see more reverse charging coming in for other industries. Perhaps that might be on the agenda in future years, but 4.5 years, and I think that these rules have worked very well.
So Neil, some builders supply services on longer term contracts that can go on for several years. I'm thinking of bigger projects like HS2. When do builders have to issue invoices and declare output tax on those kind of projects?
Yeah, that's right. Continuous supply of services is what we're talking here. Normally, many construction jobs have a clear start date and a clear finish date. And when there's a clear finish date, the output tax is due on the finish date, unless an invoice or payment is received within 14 days, which is known as an actual tax point. And then the later date is the point when it goes on the VAT return. The exception, of course, is cash accounting scheme, when the income doesn't go on the VAT return until the customer pays. So continuous supply services, we only get a tax point created when either an invoice is issued or a payment received, whichever happens sooner. Now, in the construction industry, in many cases, the reverse charge will apply on these jobs anyway, because they come under the new 2021 regulations. But the other thing to be aware of is that in many industries within the construction trade now, self-billing is very common, because in the case of a lot of building work, surveyors measure the value of work carried out, say, at the end of a calendar month. So it's unusual. The customer knows how much work has been done by their builders, and therefore they can self-bill to the seller of the services. And with self-billing, that has to be agreed between the buyer and the seller. So it's not something that can be adopted by the buyer without agreement with the seller. It's a two-way agreement process. And then the self-billed invoice will become the tax point. And in those cases, if there is a self-billed invoice in the process, then the builder selling the services cannot issue their own tax invoice for obvious reasons, to prevent duplication of input tax. So continuous supply services, tax point, receipt of payment, or invoice date, whichever happens sooner.
I guess that bad debts are quite a high potential risk in the industry. Can you just remind us of the rules surrounding bad debts and getting relief for them?
Yeah, well, the best way of avoiding bad debt issues for any business, whether it's construction industry or any sector, is to use the cash accounting scheme. Now, the cash accounting scheme, it is linked to turnover. So the joining threshold is your annual taxable sales have to be less than 1.35 million, excluding VAT. The exit threshold is much higher at 1.6. So if you can use the cash accounting scheme, then it takes away the bad debt risk, because you don't put VAT on a return until you've been paid by your customer. So there's no VAT accounting on debtors, as with normal accounting. The disadvantage of cash accounting is that you can't claim input tax, of course, until you pay your suppliers. So if you're a business that gets customers who pay very promptly, and you pay your suppliers very slowly, then cash accounting might not be very helpful. And for builders, if their work is zero rated anyway, in many cases, or 5% VAT, then the cash flow benefits of accounting, the cash accounting scheme are quite limited. So bad debt relief, 2 key rules: the debt must be more than 6 months overdue for payment, and also written off in the accounts of the seller. And when we say 6 months overdue for payment, that's not 6 months from the invoice date. If an invoice is, say, on 30-day payment terms, then the point it can be written off is 7 months after the invoice date, i.e. 1 month for the payment, then 6 months for the overdue. And also the invoice in question must be written off in the accounts of the seller. So in other words, creating a bad debt expense account, debit bad debt expenses, and credit debtors to show it's actually recorded in the accounts. If the customer subsequently pays, then you account for output tax on the payment when it's received, or the part payment received, to correct that situation.
Thank you.
One of the complex areas of VAT is the place of supply rules when you carry out services for customers based overseas. So what is the position here for construction services?
Yeah, I'll share with you a true story from about 15 years ago, involving a decorator. And this decorator was not VAT registered. His total turnover was over the VAT threshold. Now, the current VAT threshold is 90,000, so let's work with that one. So annual sales of 90,000 or more creates the need to register. So I don't know if they still do it, but in those days, and until recently, HMRC used to look at turnover on a self-assessment tax return for a business or a limited company with a CT 600. And if they saw turnover over the VAT threshold and no VAT number, and the activity of the business was not exempt, like an insurance broker or financial services, they used to do a follow-up and say to the business owner, why haven't you got a VAT number? Your turnover's 110,000 for the year to 31st of March 2025. We've just got your tax return on the 30th of January 2026, day before the deadline. We want to go back and register you. Then there is a problem. And with late VAT registration, HMRC can go back up to 20 years. That's different to 4 years with correcting errors. It's 20 years to correct the register. So back to this story, a decorator, exactly as I've just explained, he had turnover above the VAT threshold, so let's say 110,000, and HMRC were chasing a late registration. Now, this particular guy, he was actually doing some of his work in Ireland for building businesses in Ireland, which is about a quarter of his turnover, or probably a third. So let's say that was 30,000. So 110,000 over the VAT threshold, 30,000 being done in Ireland. Now, when it comes to land supplies, and when we talk about land supplies, I'm talking about both building services linked to land, like a plumber or a decorator. I'm also talking about professional services like surveyors, architects, or estate agents. The VAT charge is all about where the land or building is based that's being worked upon. So in the case of a decorator working on properties in Ireland, and this is obviously Ireland, not Northern Ireland, this is Southern Ireland, then the place of supply for VAT purposes is where the building is located, which is Ireland. That's not the UK. Therefore, it falls out of the test as far as the VAT registration threshold is concerned. So 110,000, 30,000 is place of supply in Ireland, 80,000 is the UK turnover. That's less than the 90,000 threshold. So that avoids the need to register for VAT on a compulsory basis. It's actually outside the scope of VAT, place of supply Ireland. Now, where builders need to be a little bit careful, in that example I've just talked about, the working for a builder in Ireland, the UK decorator does not need to get a VAT number in Ireland, because under Irish VAT law, the customer, the building business, can account for output tax and claim input tax doing a reverse charge entry therefore taking away the need to register for VAT for our UK decorator. However, where care is needed is where, let's say, a UK-based window cleaner is cleaning windows in Ireland for private households. Now, private households are not going to be VAT registered, so there's no scope for them to account for reverse charge because they haven't got a VAT return, so you can't suddenly deal with the VAT. And the twist to the tail there is that the UK builder or window cleaner or decorator working in Ireland or any EU country for B2C customers who haven't got a VAT number will need to register VAT and charge local VAT in that country. And one of the twists here is that a business only gets a VAT threshold in its own country. So a UK decorator working in Ireland does not benefit from any Irish VAT registration threshold. It's a zero threshold. So basically, if in theory, well, not in theory, by law, if a window cleaner goes to Ireland and does £100 of work cleaning a few windows for some friends over there, then it needs an Irish VAT number, place of supply Ireland. So land services are important to think about when it comes to the place of supply rules, because it's all about where the land is or building's based, not where the supplier's based, the customer's based, or even where the work's performed. Now, many professionals work from, say, London or the UK, working on, it might be devising plans or structures for a property in France or Ireland. That is place of supply France or Ireland. So a little bit of care needed when it comes to work on overseas buildings and land.
Thank you, Neil. So I know there's potential for small builders to use the flat rate scheme, but I understand that you think that's not very wise. Why is that?
Yeah, that's right. The flat rate scheme, I think the flat rate scheme had its RIP day, rest in peace day, on the 1st of April 2017, when HMRC realised that many businesses were making big windfalls by using the flat rate scheme. In other words, they were charging VAT at 20% of their customers, collecting 20% VAT, didn't have much input tax to claim, and therefore made quite a big profit on the VAT that they collected. And often they could apply a 12% rate for other services or any other activity, which if you're collecting 20% and only paying over 12, you're making quite a nice windfall. So the reason I think it's a no-go area for builders is, I'll give three main reasons. The first is that there are actually three different potential rates for builders depending on the percentage of their turnover that's materials. And there's three different rates for builders within the flat rate scheme. A builder that buys in quite a lot of materials can get not a bad rate of 9.5%. And always bear in mind that the flat rate percentage applies to gross income. So it's VAT inclusive income times your flat rate, not the net income. 9.5% is the lower rate for builders that do labour and material jobs, and therefore they've got quite a lot of input tax they're sacrificing on their materials. So understandably, they get a lower flat rate percentage because, as we know, the flat rate scheme, you don't claim input tax on your expenses unless it's capital goods more than £2,000, including VAT. The higher rate is for basically labour only builders, which is 14.5%, which is not particularly good. But the worst rate is basically for a business, any business that does not buy in many goods in their business, and they fall into this limited cost business that was introduced on the 1st of April 17, as I mentioned, where a rate of 16.5% is applied to gross income. Now, to give you some numbers about how this 16.5% rate is bad news, full stop, is if you think of a business that's got 100,000 a year turnover, plus VAT, so it's collecting £120,000 VAT. It can join the flat rate scheme because the threshold for the flat rate scheme is 150,000 of sales in the next 12 months, excluding VAT. So 120,000 comes in, gross income, 16.5% is the rate that's applied on the gross income if the business does not buy in lots of goods. And that works out a payment of £19,800. So in effect, on £100,000 plus VAT, the limited cost business rate is only giving you credit of input tax of £200 a year, £50 a quarter. It's almost saying no input tax credit is given with this particular draconian rate of 16.5%. And what makes that worse is you need to apply that test. Are we a limited cost business at the end of each quarter? So it's not a case of doing it once a year. Every quarter, you've got to go through this process as a builder. Am I 9.5%, a 14.5%, a 16.5%? And thirdly, the rules about what is relevant goods for the 16.5% test are very complicated. So, for example, you exclude road fuel, which is goods, unless you're a taxi business or car hire business where the road fuel is used as your tool of trade. And food and drink is excluded if it's, for example, subsistence for employees. So there's all these quirks about the 16.5% rate. And the final reason why the flat rate percentage is not particularly good for builders is because the flat rate percentage, whether it's 9.5%, 14.5%, 16.5%, is applied to zero rated sales and also 5% sales as well. So if a builder's got mainly zero rated sales, then again, it makes complete sense to stay out the flat rate scheme and adopt normal VAT accounting. So for builders, I would say no go.
Thanks, Neil. Just to move on to the final sort of subsection then, and I think you did me a case write-up fairly recently, a VAT tribunal case involving business splitting. From memory, it was about the sale of carpets and charging for fitting the carpets. If I remember rightly, the fitters were invoicing the customers, and the fitters themselves weren't VAT registered. Is that? Can you remind us what happened there and what the key points were?
Yeah, that's right. The case was United Carpets Franchises Limited, and what is interesting about this, I recently bought a carpet in my own apartment, and what was made it doubly exciting, not just having a new carpet, but a little bit of VAT as well, was that the supplier, the carpet shop I use, which is a fairly big carpet shop, but not a big player, a major player, did exactly the same thing as the case we're talking about, the United Carpets Franchiser Limited case. The way it works is you go into a carpet shop, you say, I want to buy a carpet, I'd like it fitted as well. And the carpet shop say, yes, we'll sell you the carpet for £500, including VAT. And here's a list of carpet fitters you can contact or will contact for you. You pay them directly, they'll invoice you directly, you instruct them what you want. And you'll pay them, let's say, £100, and they trade below the VAT threshold. They're sole traders, trading below 90,000. They don't charge VAT. So on the labour element, it's £100, no VAT. And HMRC looked at this, and they looked at this particular company's website, and it was described as free fitting, and we provide a free fitting service. So the marketing on the website was basically saying to the customer, if you buy a carpet from us, you get free fitting. But that wasn't the commercial reality. The commercial reality was that the carpet company had a contract with the customer to sell the carpet, and they made it crystal clear that the fitting was done by a separate business, and the separate business will be invoicing and paid by the customer, and that separate business wasn't VAT registered. It's a bit like, I haven't seen it for a long time, but it used to be that if you bought a car, it would say, buy your car in January, then you won't pay any VAT. Well, you're still paying VAT. It's just that the dealer discounted the price to the customer to reflect the VAT element. So it's still VAT being paid. So in one sense, there was a slight own goal by the carpet shop here that they put on their website free fitting service and we'll sort it all out for you. The reality was that there was two separate supplies taking place, one of fitting, no VAT, and one of carpet shops, or carpet, sorry, with VAT. When it comes down to it, the two key issues are what contracts say between the various parties, and also what the customers perceive is happening in practice. And the good news for this particular company was the VAT was about 496,000. So we're not talking about small beer here. The taxpayer won the case, in my view, quite rightly, because it was all set up commercially spot on. And since the first tier tribunal made their decision in favour of the taxpayer, HMRC have gone on their website and confirmed that they are not appealing that decision to the upper tribunal. So they've accepted the decision, and it's a useful one to quote in similar circumstances. Let me just make sure I've got the right company name there. United Carpets Franchiser Limited. Make sure the franchiser is in brackets.
Yeah, excellent. I mean, I guess with those kind of things, each arrangement's got to be looked at, and each case will be judged on its own merits. I guess the key question there is whether the numbers are going to be big enough to justify the extra paperwork. So what advice can you give our viewers about business splitting situations?
Yeah, that's right. The HMRC have got certain powers to treat two separated businesses as a single business. The phrase in the legislation is if they are closely connected by economic, financial and organisational links. And the key word that I emphasise there when I'm advising on this issue or writing about it is the word and. In other words, for HMRC to issue a direction, say these two businesses, usually one is VAT registered and one isn't, and the objective is to bring them both into VAT as a single entity, HMRC have got to prove all three links, economic, organisation and financial. One or two out of three isn't good enough. That's number one. And also, when it comes to HMRC correcting that situation by issuing a direction to both of these entities, they can only take action from a current or future date. So if the split has been done correctly, i.e. separate bank accounts, separate invoicing, separate websites, separate separate marketing, separate buying, separate suppliers, then HMRC can only go back or take action from a current or future date. What I say very clearly on this topic is it works best if there's a clear different activity going on between the two entities. So I had one done recently where a builder was doing general building work, going to houses doing repair work, and separately in the summer was doing landscaping and gardening work. Now, to me, there's two distinct activities there. Landscaping and gardening in the summer, outdoors, enjoying the good weather, is different to doing general repair work on, repairing boilers or sorting out dodgy windows or whatever. So in that situation, it's easy to have a separate trading name, separate supplier accounts, separate bank accounts, and therefore a business split will work. But who knows, if the VAT registration threshold comes down to, 30,000 rather than 90,000, where most businesses become registrable anyway in the UK, similar to what happens in the EU where there is a low registration threshold, then business splitting will not have the same appeal because the numbers become much lower. But I think as well, it requires the clients to be organised to be able to split and not overlap between bank accounts, and whole business A is a bit short of money, will get the supplier to invoice business B and they've got the money and it all gets muddled up. So it needs to be a very clear split to make it work, and it can work, and it does work very often. The key is to have separate legal entities, either two limited companies, sole trader partnership, and ideally a different mix of individuals involved in the two businesses as well.
Excellent. Right then, I think we're just about out of time actually. We didn't get a chance to do a live Q&A, unfortunately, because of the technical issues. I do sincerely apologise to the viewers there for that. But if you do have any questions for Neil, please do contact me on the email that I'll put in the description for the video, and we will do our very best to follow up. So the recording will be up on our YouTube channel, as well as being on the media section of Tax Essentials for Advisors. I do invite everyone to subscribe to the channel so you can get our regular tax and VAT updates, as well as all our webinars. We'll also be putting out some really helpful content after the budget, which is just under a fortnight away now, isn't it? So my thanks again for Rachel for co-hosting with me and making my job so much easier, and of course to Neil Warren for his excellent insights, and of course to all of you that are watching as well. We'll see you again in February for the next session, where I think we're going to be looking at making tax digital, which will be imminent at that point. So thanks again and goodbye.